Chapter 1: Investment versus Speculation. Results to be expected by the intelligent investor. This chapter will outline the viewpoints that will be set forth in the remainder of the book. In particular, we wish to develop at the outset our concept of appropriate portfolio policy for the individual non-professional investor. Investment versus speculation. What do we mean by investor? Throughout this book, the term will be used in contradistinction to speculator. As far back as 1934, in our textbook Security Analysis, we attempted a precise formulation of the difference between the two as follows. An investment operation is one which, upon thorough analysis, promises safety of principal and an adequate return. Operations not meeting these requirements are speculative. While we have clung tenaciously to this definition over the ensuing 38 years, it is worthwhile noting the radical changes that have occurred in the use of term investor during this period. After the great market decline in 1929-1932, all common stocks were widely regarded as speculative by nature. A leading authority stated flatly that only bonds could be bought for investment. Thus, we had then to defend our definition against the charge that it gave too wide scope to the concept of investment. Now our concern is of the opposite sort. We must prevent our readers from accepting the common jargon which applies the term investor to anybody and everybody in the stock market. In our last edition, we cited the following headlines of a front-page article of our leading financial journal in June 1962. Small investor bearish, they are selling lots short. In October 1970, the same journal had an editorial critical of what it called reckless investor, who this time were rushing in one of the buying side. These quotations well illustrate the confusion that has been dominant for many years in the use of the words investment and speculation. We think of our suggested definition of investment given above and compare it with the sale of a few shares of stock by an inexperienced member of the public who doesn't even own what he's selling and has some largely emotional conviction that he will be able to buy them back at a much lower price. It is not irrelevant to point out when the 1962 article appeared, the market had already experienced a decline of major size and was now getting ready for an even greater upswing. It was about as poor a time as possible for selling short. In a more general sense, the later used phrase reckless investor could be regarded as a laughable contradiction in terms, something like spendthrift misers, where this misuse of language not so mischievous. The newspaper employed the word investor in these instances because, in the easy language of Wall Street, everyone who buys or sells a security has become an investor regardless of what he buys or for what purpose, and what price, or whether for cash or in margin. Compare this with the attitude of public toward common stocks in 1948, when over 90% of those queried expressed themselves as opposed to the purchase of common stocks. About half gave their reasons not safe a gamble, and about half the reasons not familiar with. This is indeed ironical, though not surprising, that common stock purchases of all kinds were quite generally regarded as highly speculative or risky at a time when they were selling on a most attractive basis and due soon to begin their greatest advance in history. Conversely, the very fact they had advanced to what were undoubtedly dangerous levels as judged by past experience later transformed them into investments and the entire stock buying public into investors. The distinction between investment and speculation in common stocks has always been a useful one, and its disappearance is a cause for concern. We have often said that Wall Street as an institution would be well advised to reinstate this distinction and to emphasize it in all its dealing with the public. Otherwise, the stock exchange may someday be blamed for heavy speculative losses which those who suffered them had not been properly warned against. Ironically, once more, much of the recent financial embarrassment of some stock exchange firms seems to have come from come from the inclusion of speculative common stocks in their own capital funds. We trust that the reader of this book will gain a reasonably clear idea of the risks that are inherent in common stock commitments, risks which are inseparable from the opportunities of profit that they offer, and both of which must be allowed for in the investor's calculations. What we have just said indicates that there may no longer be such a thing as a Simon pure investment policy compromising representative common stocks in the sense that one can always wait to buy them at a price that involves no risk of a market or quotational loss charge enough to be disquieting, disquieting, disquieting. In most periods, the investor must recognize the existence of a speculative factor in his common stock holdings. It is his task to keep this component within minor limits and to be prepared financially and psychologically for diverse results that may be of short or long duration. Two paragraphs should be added about stock speculation per se, as distinguished from the speculative component now inherent in most representative common stocks. Outright speculation is neither outright speculation is neither illegal, immoral, nor for most people fattening to their pocketbook. More than that, some speculation is necessary and unavoidable. In many common stock situations, there are substantial possibilities of both profit and loss, and the risk therein must be assumed by someone. There is intelligent speculation as there is intelligent investing. But there are many ways in which speculation may be unintelligent. Of these, the foremost are speculating when you think you are investing, speculating seriously instead of pastime when you lack proper knowledge and skill for it, risking money more in speculation than you can afford to lose, risking more money in speculation than you can afford to lose. In our conservative view, every non-professional who operates on margin should recognize that he is ipso facto speculating, and it's his broker's duty to advise him. And everyone who buys a so-called hot common stock issues or making a purchase in any way similar thereto is either speculating or gambling. Speculation, either speculating or gambling. Speculation is always fascinating, and it can be a lot of fun while you're ahead of the game. Okay, speculation is always fascinating, and it can be a lot of fun while you're ahead of the game. If you want to try your luck at it, put aside a portion, the smaller the better, of your capital in a separate fund for its purpose. Never add more money to this gun just because their market has gone up or profits are rolling in. There is the time to think of taking money out of your speculative fund. Never mingle your speculative and investment operation in the same account, nor in any part of your thinking. Never mingle your speculative and investment operations in the same account, nor in any part of your thinking. Okay. Results to be expected by the defensive investor. We have already defined that the defensive investor is one interested chiefly in safety plus freedom from bother. In general, what course should we follow and what return can he expect under average normal conditions, if such conditions really exist? To answer these questions, we shall consider the first what we wrote on the subject 7 years ago. Next, what significant changes have occurred since then in the underlying factors governing the investor's acceptable return, and firmly what he should do and what he should expect under present-day early 1972 conditions. What we said 6 years ago. We recommend that the investor divide his holdings between high-grade bonds and leading common stocks that the portion held in bonds be never less than 25% or more than 75%, which the converse being necessarily true for the common stocks component, that his simplest choice would be to maintain a 50-50 proportion between the two, with adjustment to restore the equality when market development had disturbed it by as much as, say, 5%. As an alternative policy, he might choose to reduce his common stock component to 25 if he felt the market was dangerously high, or conversely to advance it toward the maximum of 75 if he felt that a decline in stock prices was making them increasingly attractive. In 1965, the investor could obtain about 4.5 on high grade taxable, 4.5 on high grade taxable bonds, and 3.5 on good tax free bonds. The divided return on leading common stocks with the DJIA at 892 was only about 3.2. This fact and others suggested caution. We implied that at normal levels of the market, the investor should be able to obtain an initial divided return of 3% and 3.5 and 3.4% on his stock purchases, to which should be added a steady increase in the underlying value in the normal market price of a representative stock list of about the same amount, giving a return from uh, dividends and appreciation of combined of about 7.5%. So messy. The half and half division between bonds and stock would yield about 6% before income tax. We added that the stock component should carry a fair degree of protection against the loss of purchasing power caused by large scale inflation. It should be pointed out that the above arithmetic indicated arithmetic indicated expectations of a much lower rate of advance in the stock market than had been realized between 1949 and 1964. The rate had averaged a good deal better than 10% for listed stocks as a whole, and it was quite generally regarded as a sort of guarantee that similarly satisfactory results could be counted on in the future. Few people were willing to consider seriously the possibility that the high rate of advance in the past means that stock prices are now too high, and hence that the wonderful results in 1949 would imply not very good but bad results for the future. What has happened since 1964? The major change since 1964 has been the rise in interest rates of first grade bonds to record high levels, although there has since been a considerable recovery from the lowest price of 1970. The obtainable return on good corporate issues is now about 7.5% and even more against 4.5% in 1964. In the meantime, the dividend return on DGA type stocks had a fair advance also during the market decline of 1969 and 1970. But as we write with the Dow at 900, it is less than 3.5 against 3.2 at the end of the 1964. The charge in going interest rates produced a maximum decline of about 38% in the market price of medium return, say 20-year bond during this period. There is a paradoxical aspect to these developments. In 1964, we discussed at length the possibility that the price of stock might be too high and subject subject ultimately to a serious decline. But we did not consider specifically the possibility that the same might happen to the price of high grade bonds. Neither did anyone else that we know of. We did warn on page 90 that the long term bond may vary widely in price in response to changes in interest rates. And the what has since happened, we think that this warning with attended examples was insufficiently stressed. For the fact is that if the investor had given some in the DJIA at its closing price of 874 in 1964, you would have had a small profit there on in late in 1971, even of the lowest level 606